Inside America's Boardrooms, the informational show for board members and corporate secretaries. Brought to you with knowledge partners NASDAQ, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, R.R. Donnelly, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of Inside America's Boardrooms. I'm T.K. Kerstetter, CEO of Boardroom Resources, and it's my pleasure to welcome you to the show. Today we're going to be talking about capital allocation, the repurchase shares or pay dividends. And joining me to talk about this topic is a familiar face. Welcome Paula Loop, who's the leader of PwC's Governance Insights Center. Paula, welcome back.
Thank you. I'm happy to be here.
So we always try and tackle good topics. This is another good topic, this capital allocation, because you and I both recognize how important this is as a topic. Yet when it sort of gets pushed down by the more popular topics like compensation or cyber risk, which sort of dominate. But I can't think of a more important topic from the board's perspective to be involved in the capital allocation and the decisions of what to do with that capital. So before we sort of dig into the publication that your center has produced, why do you think that is? Why do you think that capital allocations is it because it's just not sexy, or what's the deal here?
Well, I think there's a lot of different elements. I mean, first of all, in 2015, the all-time amount of cash on the balance sheet for S&P 500 companies made it to almost $1.5 trillion. So there's a huge amount of cash, so this thing should be getting and is getting a lot more attention. I think the capital allocation plan of a company is really tied into the strategy plan. And so because of that connection, maybe people originally weren't bifurcating those and talking about one or the other, but it is very much linked up to the whole strategic plan that the company has and what they're going to do there. And I think a little bit more, the devil also is in the details from company to company. So some companies have lots of cash on their balance sheet, or it appears they have a lot of cash, but maybe a lot of that cash is overseas and can't be repatriated without some sort of, enormous or unwieldy tax consequence. So the devil's in the details as to what a company is actually doing with that cash and what they're thinking through about their allocation plan and how much they really want to talk about that publicly as well.
And we'll get to that about talking about that. But so you guys tackled this by creating a publication titled, "Is Cash Burning a Hole in Your Pocket? Thinking Through Share Repurchases and Dividends." And in that publication you talked about how activism has sort of changed the thought process and trying to make that stuff more transparent. And you sort of hint a little bit in that maybe not all companies grasp the issue of this short-term decision of what some shareholders want versus the long-term impact of that. What does your publication sort of offer in the way of advice to boards centered around that?
So we took a look at this concept, and again, we did a little bit of a compare-contrast between share buybacks and dividends. So we tried to do that a little bit, and we also tried to direct considerations or things that that should be considered from a board's perspective as well from an investor's perspective. So there's lots of different things going on in this publication, I think. And if you think about it, dividends, I think broadly people think it's more of a long-term commitment. It's a long-term indication that, a company is going to commit to giving a dividend quarterly and going forward over several years. And it's usually harder to pull that back than it is a buyback program. On the other hand, a buyback program, those have been much more popular lately than they were in the past, and a little bit more controversial as well. So unfortunately, I think companies, the indication of buying back your shares is that you think the shares are undervalued, that you think that they're worth more than they're currently trading at, and therefore you're going to go out and buy some. Unfortunately, what history shows us is most companies, when they are buying back shares, they're actually buying at a high price. And as you know, with the stock market, trying to figure out where a low price is, where it's a good time to buy is very challenging. It takes, I think it takes a lot of smarts. It takes patience, and that maybe hasn't necessarily all come into play for a lot of companies and their buyback programs, and so therefore it's been done, the purchase price has been a little higher than optimal. And I think that benefits investors that are leaving, that are selling, so they're on their way out. It doesn't benefit the current investor. So buybacks have had a little bit of a interesting thing. And then the other thing that investors are bringing up with buybacks is the impact that it has on some of the company's metrics that might be used in CEO or other executive compensation. So buybacks do impact EPS. If EPS is a metric that is used in determining the CEO's compensation, then this could be problematic. And in fact, in this proxy season, a lot of investors have come forward and asked comp committee chairs to make sure that they're considering pulling out the impact of buybacks from the calculations for CEO compensation. So it's getting a little more attention.
Yeah, it's always a challenge from the board's perspective. Obviously, conditions change. You have, like you said, you have issues where the board may be making a very innocent decision of what's best for the company, and it looks like maybe they're favoring management when they really have no intentions, of doing that. So, and then you always have the board challenge of long-term, short-term. You have shareholders, a group of shareholders that wants you to reward the shareholders today, and then you have the group of long-term shareholders that say, hey, we're in this for the long haul. Don't make poor decisions short-term that are going to affect the long-term.
Yeah, and there's lots of things that you can do with your cash, right? So I think investors, depending on what their mindset is, where they're thinking, they want to think about what the different options are and lay all of those out. So, it is a very challenging topic, I think, for directors, and something they are spending a fair amount of time on now.
And one of those challenges you did talk about, and that is sort of that the boards need to sort of communicate their strategy. At the same time, we both know that it is part of strategy. So you can't just open your kimono and say, here's our strategy and here's what we're doing. Competitors would love for you to be in that position. I remember Apple, when it had its hoard of cash, probably still does. I haven't looked recently, but I remember, I think it was Carl Icahn who really wanted them to either say, hey, here's what we're going to do with this $50 billion, or, give it back, to the shareholders. And I remember the board talking about the sensitivity of disclosing of whether they were going to do an M&A transaction, or, really what they were going to do with the money. And so I saw both sides. Because that was a pile that needed to have some attention as a shareholder given to it. So talk a little bit about the challenges and maybe what the publication says about that too, about communicating.
Yeah, no, I think communicating is a very important thing, and investors are pushing for more transparency in a lot of different areas, right? So I think this is just one more thing that's sort of pushing directors to the edge of their transparency comfort zone, let's just say. And companies as well, so not only the directors, but the companies as well. But I think companies really do need to step back and think about what is it that they can say about their capital allocation plan, because investors are starting to demand something. You probably aren't going to be able to tell the whole story. You don't want to tell it all, but there's probably something you can say, and there is a way that you can say it. And I think that's what they need to step back and think about what they're going to do. Some things may be very obvious, and it could be some clarification about the fact that we have a lot of cash, but we can't repatriate it because of tax purposes. So that would be an easy one. Or other things about broader long-term plans that you might want to get out there in general, no specific terms, just to give people more comfort about that you're thinking about it, you're aware of where you are from a capital allocation perspective, and you want to give them a little bit of information, but probably not all of it.
Well, get legal ready, because as you and I know, they will pour over that statement what goes out to the public. But just a curious question. Do you hear much about special dividends? Because that to me was always a great tool.
Yep.
Because you weren't making that formal commitment, yet it was a statement about how you were doing. And it rewarded the shareholders, you know, on a one-time basis, and yet you didn't have the pressure of the continuity of keeping up if you just raise your dividend. What's your experience?
I think special dividends is a very good option for people, and in fact, we did see a couple of those this year coming out of calendar year 15 results, and I think companies played those very well. And you're absolutely right. You're not committing to a future higher dividend or a future commitment to it, but on the other hand, it has a completely different sense of what it does for the shareholder, certainly what it does for EPS and other things than a buyback. So I think it's a great option and something that companies should continue to think about.
So I think this is a great topic. I think this is probably a must-read for most directors because, again, it's a topic that isn't readily talked about and should be. How does somebody, how do our viewers get a copy of, the easiest way to get a copy of this?
Go to our website, the PwC website, and look under there for the Governance Insights Center, and you go right in there and you'll be able to see all of our publications, including this one, our most recent one.
And we'll make sure we get that on our site as well in case somebody wants to come in and find it that way.
Terrific.
But, Paula, thank you for joining us on this important topic. And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week where we take a look at another critical topic that'll help you be a better board member or committee member. So we'll see you then.
Join us again next week for Inside America's Boardrooms. Brought to you with Knowledge Partners, NASDAQ, the Center for Audit Quality, and PwC. Along with content contributors Equilar, Meridian Compensation Partners, Wilson Sonsini Goodrich and Rosati, R.R. Donnelly, and the Society of Corporate Secretaries and Governance Professionals.